but not everybody.
Sorry, Mark. Sorry.
Thank you, Rachel. Yeah. So we're gonna record today's session because I know a lot of folks, they wanted to be here or couldn't make it. So we'll record it. That way we can share this, or you can watch it again later on. So let me share my presentation real quick. And let's see. What I thought I would do is, my presentation has a couple sections, is we would kind of do a section and then pause and go for questions. And that way we don't go all the way through without taking a break, because that might be a little too much. Let me see. Sharing participants. There we go. So if y'all can see my PowerPoint presentation.
Yes.
Yes, we can.
Okay, great. Let me start.
Yes.
There we go. Okay. So guys, I'm a newer realtor. I just joined RE Connection in February. So I'm excited to be with one of the best brokerages in North Texas and across Texas. I don't know if you heard the news. We recently went up in our ranking for North Texas. So super exciting. But I'm also a mortgage broker. I'm also a loan officer. So I've been doing mortgages about 5 years now. I used to work at Chase Bank right after college and actually started my own company a couple years ago. So I work with home buyers, investors, first-time buyers, all different kinds of scenarios. So as I'm sure you've heard, interest rates are a little bit higher. I looked at the data, it's actually 3% higher than this time last year, which is unbelievable. So in today's presentation, I want to talk about making a plan, right? So how are we going to help our buyers the rest of this year into next year? If rates are so high, how are we going to get our clients into a house so they can start building equity, stop renting, or getting in now, even if the rate is not great? What's our strategy for them for the long run? Mortgage. My company is Mortgage on a Mission, and if you haven't met me in person, this is what I look like. This is my old mugshot a couple years ago. So today, what I want to talk about is first, why does the realtor need to know anything about the buyer's financing? I know that a lot of realtors are focused so much on contracts, contingencies, the inspection, that sometimes we don't give financing enough attention. So I want to just go over the basics of what I think really every realtor should be aware of. That way you're not caught off guard if something happens that you weren't expecting. And we really have to start that conversation with the pre-approval letter. What the letter does and does not say, because there is still some confusion with home buyers. They get a pre-approval letter, they think, great, this means I'm going to get a mortgage. And it actually doesn't mean that. So we're going to go over the pre-approval letter. And then let's go over the timeline for your buyer from the seller accepting their offer through the option period with home inspection, getting the appraisal, title work, all the way to closing. Because there's some key dates that we want to keep in mind to make sure we're protecting our buyer's earnest money and making sure that our lender, whoever that lender is moving quickly and is communicating with us. We don't want our buyer to not know what's going on. So, and next we're going to go over some strategies to help our buyers as rates are hitting 6%. There are things we can do to get them a lower interest rate. So we're going to talk about that. And credit scores. Not going to go into a huge amount of detail on FICO credit scores, but I did want to point out some things that I've realized a lot of agents are not aware of, and that is even a tiny increase to a borrower's credit score can help them save thousands of dollars. I had a lady last year, her credit was a little lower, and we worked with her for 7-8 weeks and got her score up. It wasn't a huge improvement. It was just a small improvement, but she saved about $3,000. So we're going to talk about that. And then finally, mortgage insurance. I know that most buyers say, Ben, I want to do a 20% down payment, right? I don't want to do mortgage insurance. And while that is a good strategy for some people, other people can't avoid a smaller down payment, 5%, 10%, 15. And even if your buyer can do 20%, there actually might be a better loan scenario for them. Mortgage insurance is not always this really expensive thing that we should always avoid. So we'll talk about what sets the price for mortgage insurance, why it's not always a bad option. So that's what I want to talk about tonight. And before we start, does anybody want to tell me what you think is so important for a realtor to know about your buyer's financing? So why does a realtor need to know just the basics about mortgage financing? Has anybody had a scenario recently where something went wrong, or you wish you knew something, or you did know something and you helped your buyer? If anybody wants to jump in. If not, I've got some points I can go over. And feel free to jump in on this slide if you think of something. So when I gave some thought to this question, really the number one thing that stood out to me when I thought about this question is, guys, as a realtor, we are a fiduciary to our client. What that means is that we have a legal responsibility to put their best interest first. As a loan officer, because I'm also a loan officer, as a loan officer, we don't have that duty to our client. So let's say your buyer gets a pre-approval letter and they go under contract, and then the loan officer says, hey, I'm so sorry, something happened. We can't get you approval for your mortgage, and they lose their earnest money. Is the loan officer or the lender responsible for making the buyer whole again? And the answer is no. There's no liability if a mistake gets made. As a realtor, guys, if we say something, if we give our client the wrong advice, we could potentially be held responsible. With lenders, loan officers, that's just not the case. So as a realtor, it's really important to know how to help your client, how to help them navigate some of these scenarios, because really you are the person looking out for them. There are some great people that do mortgage work. I hope I'm one of them, but the industry standard just is not there, right? Also, knowing your buyer's strengths and weaknesses is going to help you write a stronger offer for them, help get them under contract faster, more smoothly as the agent. When you are giving great service to your client, guys, that's going to be more referrals down the road, right? So if you know the basics about the mortgage, you're going to be able to answer questions and get more clients, people who maybe they wouldn't have chosen to work with you, but because you were able to impress them with how much you know, they decided, hey, I want to work with Geeta, right? I want to work with Rachel. I want to work with this agent because he or she was able to help me answer those questions, even though I know they're not a mortgage professional. This is a realtor who is very well-rounded and knows their stuff. I want to work with them. And as a result, that's another paycheck in your pocket, right? So guys, pre-approval, I could talk about pre-approval for a long time. I had to focus on just a couple points. First of all, what is pre-approval? Pre-approval is just a quick look at a home buyer's financial condition. We're going to do a credit inquiry. It can be a hard pull or a soft pull. The difference is a soft inquiry is not going to affect credit scores. A hard inquiry might not affect credit, or it might. It really just depends. Loan application is going to ask about 2 years for employment history, 2 years of residential history where they've lived. It's going to ask them about previous homes they've owned, if they're a first-time buyer, if they're a veteran. It's going to ask about immigration status. It's going to ask about assets available for their down payment and closing costs. Pre-approval is also a review of supporting documentation. So I get a lot of phone calls from buyers. They call me and say, hey, Ben, I've got great credit. I owe very little. I make great income. I say, great. Let's look at the loan application. You'd be surprised how many people don't know how much they owe, how much the car payment is, how much the minimum credit card payment is. Or they may tell me, hey, Ben, I have all this money saved up for my down payment. But when I look at 2 months of bank statements, I see some recent large transfers of cash coming in. And as some of y'all know, lenders want to see past 60 days, assets have been in that account, seasoned, right? There's no large transfers. So pre-approval is just that initial phone call with the buyer, but we're also verifying a lot of the claims and information on the application, okay? And essentially, everything we're doing is trying to answer one question. Does the buyer have the ability to repay this mortgage? It is sad that sometimes we have to say no. We have to say, you're not ready for the mortgage, right? I can't get you pre-approved for this mortgage. But what happened in 2005, 2007 was lenders did not have to answer this question. Lenders didn't have to say, is this mortgage right for this person? Are they going to be able to make payments? Are they going to be able to keep the house and not go through foreclosure? So what we're trying to do with pre-approval is make sure that the buyer is ready. That way we don't put them under contract, pay a $1,000 or $2,000 option fee, 1 or 2% earnest money that they may or may not get back. So pre-approval is that first look to make sure we're not putting the buyer at risk of a mortgage they can't handle or making a deposit on a house that they might not get back. So pre-approval is not the same as a lender approval. So most of the time, a pre-approval is coming from a loan officer. And, loan officers are just like agents, right? Some loan officers have a lot of experience. Some loan officers have very little experience. And so just because you get a letter that says your buyer is able to buy a house of $500,000, right? The letter doesn't matter so much as the work that went into creating that letter. And unfortunately, a buyer might get a pre-approval letter and then later on discover that they actually don't qualify for the mortgage. And that brings me to one other point I want to make, and that is, we talk about pre-approval, but actually most of the time our home buyers are getting pre-qualified. A true pre-approval comes from the lender's underwriter. So I didn't know this when I first got in the industry, but technically a pre-approval is coming from the person that makes the decision, yes or no. And that person is the underwriter. So most of the time when you're getting a letter, it's actually a pre-qualification letter. And what I want to do now is take a look at this letter and walk you through some of the really important features. So front and center, and I know this is missing from some of my colleagues in the industry, but this very important phrase, it says, this is not a loan approval or a commitment to lend. A lot of home buyers are not aware of this. They think, I got a pre-approval letter, I'm going to go under contract, I'm going to buy the house, get lender approval. But a pre-qualification letter does not guarantee lender approval. So very important to make sure our buyers are aware of this. There's some things that they need to do in order to remain eligible, or a mistake might have been made, unfortunately. Second part of your pre-qualification letter is just a review of the work that's been done. So, and different lenders have different formats for these letters. There are some bare minimum requirements that have to be on these letters to be compliant under state of Texas rules. But in general, you're going to see a couple things: the sales price for the house, in this case, $380,000. The type of loan, so this is a FHA, fixed rate, 30-year mortgage. You're going to see the qualifying interest rate. Now, I want to talk about the qualifying rate a little bit because I know I get a lot of questions from my buyers. So they'll call me, Ben, I saw your pre-approval letter, but I saw the interest rate. The interest rate was kind of high. What does that mean? And I tell them, the qualifying interest rate is just one of several different rates you qualify for. So every buyer is actually eligible for 10 or more different interest rates. Higher interest rates have zero lender fees. Lender might be giving the borrower a credit. Lower interest rates, the lender is going to charge a fee, right, to get that lower rate. So on a pre-approval letter, when we see that interest rate right here, all this means is that if the rates go up to this rate, you are still eligible for the mortgage. So don't let that throw you off. If you get a letter and you see a super high interest rate, that's actually a good thing. That actually means the loan officer did a good job to stress test your borrower, making sure that, if rates spike 0.5% and you go under contract, you're still okay. So that's what the qualifying rate means. The next part of this letter that you might or might not see, hopefully you see this on a compliant letter from a lender, is this second sentence here. Although you are conditionally pre-qualifying, keep in mind this is not a loan approval or a commitment to lend, and there are 7 things listed here that the home buyer needs in order to get final lender approval. One of the things I want to point out to you guys is number 4. So your financial status and credit report to remain substantially the same, right? So you cannot change your job, cannot take an unpaid leave of absence from your job. You cannot take out a car loan, a new credit card, a furniture loan, okay? There's so many things that can go wrong from initial pre-qualification to that final lender approval. So we always want to highlight this to our home buyers to make sure that if they've got any questions, right, that they're reaching out, asking those questions before they apply with a car loan lender and pull credit, move money around different accounts, things like that. So that's it for the pre-approval letter, guys. I want to take a break because we've already gone through all that material. Any questions that you guys have just over that initial process of getting your buyer pre-approved, or as we now know it, pre-qualified for their mortgage? Any questions? If we don't have questions, we can stop at another time.
I have one.
Okay, go for it.
I have an investor buyer. So they are buying multiple houses, okay? So for one house, they got the pre-approval letter. They bought the house, in contract now. Again, for the second one, they got the pre-approval letter and they are in contract. So as a buyer agent, I am little bit, like a scare thing or something. Like I did a lot of effort here, and at last, because they already bought 2 properties, I don't know how much big they have company, how much, they have money. So what should I do? Should I say, okay, hold on, let me finish these 2 contracts, or I just want to converse with them more and more about the financial status or.
So Geeta's question, let me know if I got this right, Geeta, is you've worked with an investor, they bought some houses in the past, and now they're going to buy a new house, but you don't know if you can trust the lender's pre-approval or if they've made a mistake. So
No.
what you can do is that right, Geeta? Or?
They bought 2 houses by me. They are in contract.
They bought 2 houses in the past. They've already closed on those houses and they got a third one lined up that they want to buy?
Yeah.
Okay. If you ever have a doubt about a borrower's ability to borrow for a mortgage, you can always ask them to get a second opinion, right? So That's not a bad thing to do before you put in 5, 10, 15 hours. Just get a second opinion. That's what I would do if I was in your situation, just to make sure that no mistakes have been made during that pre-qualification process. Yeah.
Thank
Yeah.
you.
So how do we get to these pre-approval numbers, right? So this borrower got a letter saying you're eligible for a home price of $380,000. How do we get to that number? There's really three parts to a pre-qualification. Not the borrower's income, but the income the lender will let us use to qualify for the mortgage. So let's say that we've got a husband and wife buying a house. They both make $5,000 a month, just a base salary. So our income is $10,000 a month. They do have some monthly bonus, but they don't have 2 years history of receipt. So we can't use the bonus income. There's a lot of really technical rules, and I'm not going to get into all of them, about every type of income, whether we can use it or we can't use it to help qualify for the mortgage. So, but for now, let's look at their income as $10,000. Now on the credit report, we're going to see all of their other liabilities. So we're going to see car payment, student loan, personal loan, credit cards. If they owe IRS back taxes, I have seen that, IRS back taxes, unpaid child support, medical debt collections. We're going to see everything on credit. And what we're looking for is the monthly payment. So let's say that this couple have 2 cars and the monthly payment is $500 on each car. That's $1,000. So 10% of their income is going towards paying debts that are not the house payment. The third part of the pre-approval process is looking at what their housing payment is going to be. So if they tell me, Ben, I want to buy a house for $380,000, I wish those houses exist. It's hard to find those houses. But once they tell you a neighborhood, a school district, purchase price, we can look up what the property taxes are probably going to be based on, a couple of homes in that area. We can look at HOA dues, home insurance, and calculate the mortgage based on loan amount and interest rate. So right now, guys, we're just estimating what these things are because we don't know what the property tax is until we've found a house we want to make an offer on. But we've estimated the total housing payment to be $4,000. So 40% of their income is going to pay the house, and 10% is going to pay for their car loans. That's really as high as we want to go with our home buyers, is 50% of income going to pay off debts and housing payment. And this is, you've probably heard of this, the debt to income ratio. It's just housing payment plus non-housing payments divided by monthly income. So 50% is really as high as we can go. I've had a buyer buy a house with a 49% debt to income. And that's a really tough situation to be in, because if property taxes were not estimated correctly, if homeowners insurance costs more than we thought it would, that's a problem, because we go to 50% and the lender's going to deny that mortgage, right? In FHA mortgage, we can go a little higher, sometimes to 55%. I've seen that in the past, but conventional 50% is really as high as we want to go. Housing payment, when I talk to somebody on the phone and they tell me, yeah, our monthly income is about $10,000, I tell them housing payment, let's try to stay around $4,000. It can be a little higher. Sometimes it has to be less, but 40% is what I'm telling people these days. So next section, I want to go over just a quick Q&A session. So just a couple questions. Who wants to tell me, I'm going to pick on you, Geeta, if you want to chime in on a couple of these. Who is it with the mortgage company that decides to approve a loan or deny a loan? Kala, I see you got your hand up.
Underwriter?
I think it's an underwriter, but I had the hand up for asking a question, Ben. I'm so sorry.
That's okay. Go ahead. What's your question?
This is something that I've always had a doubt with. Let's say I want to buy a primary home. I have an investment home that I'm renting out, right? And then it's been very less, let's say 6 months, and I have an EMI on that. Would that be counted towards my debt to income, or would they have to wait for 2 years to show consistent rental income from that property? How does it work? It
That's
could
a
be
really
different.
good question. Yeah. So Kala's question was, she's thinking about buying a new house. It would be an owner-occupied house. She's not a first-time buyer because she owns real estate, right? So we can't do a 3% down conventional. We can do 5% though for conventional. But her question was, can we use the income from the tenants in her investment house to help qualify for the new mortgage? The answer is yes or no. So the FHA program is different from conventional. So FHA is a little harder if we're using a tenant income off an investment home. Conventional, the answer is maybe yes. We have to make sure the tenant income has been received consistently, but we don't need to wait 2 years. We don't need to have 2 years of receipt of tenant income to offset the mortgage on that investment house. So
Thank you so much.
hopefully that answers your question. We run
Just
into this.
Rephrase that one. When you're calculating my gross payments, like, my mortgage payments, that's going to be for the house that I'm going to buy. Would you calculate my EMI for the other home as well into debt to income ratio, or would you just leave it off because you have a rental income coming from there and there's no cash?
Yeah, no, that's a good point. So Kala, what we would do is you'd add the current house expense to your liability side and add the income on your income side. So we're considering both sides of it, but hopefully the tenant income is enough to offset the property expense.
Perfect. Thank you so much, man. That's what my question, because back in Florida, they wanted to wait for 2 years. And I have the same doubt again and again if somebody's asking me this question. Thank you so much for clarifying.
Yeah, and obviously, the details of your situation, they might be right in saying that we got to wait 2 years. Every situation is different, and we'll get to that later. There's so many different rules and different caveats and different exceptions to rules, things like that. But yeah, we run into this scenario where, let's say we've helped a first-time buyer buy a house a year or 2 years ago, and they want to buy a new house, but their credit score is lower. So they want to buy the new house with FHA. Can we use the tenant income for their current house that they want to keep and rent out? The answer is no. We can't use tenant income if we're going to use FHA to buy the new house. So they'd have to buy the new house with conventional, which is minimum 5% down payment. I just ran into that situation with a client. So the answer is top of my head, that's a tricky situation. You really always have to look at your underwriting guidelines. But Kala is 100% right. So me as loan officer, we're not deciding approval or denial. It's the lender's underwriter. And the underwriter is not issuing that pre-approval letter. So there can be a miscommunication. There can be a loan officer who is exuberant and issuing a pre-approval letter, and there's an underwriter who has 10 years of experience and says, no, there's no way. We can't use bonus income. It hasn't been 2 years. Or we can't use tenant income. This is an FHA mortgage. So it's the lender's underwriter, which normally has a lot of experience, that is making that decision, yes or no. So I know some of you guys have asked me this question in the past, and is, my buyer got denied by this other lender. Is there any way that you can help me? And really that question is asking, what are the rules for approval? What is the underwriter looking at to determine yes or no? And ultimately, guys, it's not really even the lender that makes that decision. It's the investor that the lender is going to be selling the mortgage to that decides if they're willing to accept that risk, if they're willing to accept a self-employed borrower that doesn't have a lot of experience running their own business, right? So the lender's job is not even to decide yes or no, but to just create the mortgage to then sell to the investor. So if you've got a home buyer that went to Chase Bank and Chase said, we can't use your bonus income, you don't have 2 years history of bonus income, every lender that's doing a conventional mortgage is going to say the same thing because the lenders are all following the same guidelines. There are a couple rare exceptions, but in general, that's a good rule to follow. So if your home buyer comes back to you and says, hey, I couldn't get pre-approved, they wouldn't let me use bonus income, just tell them, sure, ask a couple different lenders, but you might hear the same thing from other lenders, right? For a conventional mortgage, who's our investor going to be? If Chase Bank is issuing the mortgage and it's a conventional 30-year mortgage, who's buying the mortgage from Chase Bank, right? Fannie Mae or Freddie Mac. So these are the massive institutional investors, trillions of dollars of mortgage debt. They are issuing mortgage bonds to raise money from international investors to buy these bonds. And they're buying the loans from our lenders, so long as they conform with certain rules and guidelines that are published by Fannie and Freddie. If the mortgage is a jumbo, it's a really big loan, over $647,200 as of 2022, Fannie and Freddie are not buying the mortgage. It's a private investor, and every private investor has slightly different rules. And they're constantly changing and updating rules. So jumbo is a whole different conversation for another day. So how many mortgage rules are there? Turns out that Fannie Mae's book is over 1,200 pages long, and Freddie Mac's book is over 2,000 pages. I have not read all of them. I don't know anybody in mortgage that has. What you do is you just turn to the section that's relevant to your buyer's scenario. So, Kyle's question about tenant income, we're going to turn to the section on investment property, tenant income, and what we need to do in that scenario. And we're going to read 20 pages to see what we need to do to make sure we don't pre-approve somebody, put them on a contract, and put that earnest money at risk. So there's a lot of rules. And I know I've said this before and I'll say it again, but when the loan officer doesn't understand the rules, your home buyer gets pre-approved, later gets denied. That's when we get that horror story, right? Just that bad feeling of this transaction is not going to close and the buyer's not going to be happy, right? All right. This is what the Fannie Mae rule book or selling guide looks like. It is 1,239 pages. Incredible. Freddie Mac, this is what the section on, part of the section on income looks like. And there are rules about income like bonus income, self-employment, and a part-time job, second part-time job. So I have this open almost on a daily basis just because I get questions from agents, right? I get questions from buyers, and it's not really the job of a loan officer to know what the answer is, but to know when they need to look up the answer and how to find the answer and how to make sure the answer they give to the client is accurate. So I want to transition away from pre-approval, and I want to talk about.
Then one question, does the agent need to know all these answers?
Yeah, so realtor, I would say you don't need to know all of the answers to the questions, but a realtor should know what questions to ask. So if you've got a client that is self-employed or they've been at their current job only a couple months, I would be asking the loan officer, can you show me your work, right? How did you pre-approve my buyer? What underwriting guidelines are relevant to my buyer? And can you explain those guidelines to me to make sure that you haven't made a mistake, right? Because the loan officer is not liable if they make a mistake. It's completely reasonable to ask for them to show their work, show how you got to this answer, right? Like Geeta mentioned earlier, feeling uncomfortable, right? Giving your client 10 hours, 15 hours of your time, only to then discover that a mistake got made. So Hema, I would say You don't need to know all the rules, but definitely know what questions to ask the loan officer. And question number one is, what is the borrower's monthly income? What are their non-housing debts? What's the housing payment going to be? What's the debt to income ratio? And what are their credit scores? So you can ask your buyer's permission to have the loan officer speak openly, honestly with you. I've always been a little bit more reserved about talking about like the intimate details of someone's finances without them signing that authorization to disclose. But it is a good practice for agent and loan officer to be on the same page and really have that strong communication. Yeah, I hope that answers your question.
Yes, you did. Thank you, Ben.
Okay. So any other questions right now before I jump into the next part?
Hey, Ben, this is Yogesh. Hey, first of all, thanks for your time to go through this session. The second, I'm new to this field, and this must have been answered so many times by you. This is a basic question. Who's responsible to get the loan, basically? Is that buyer, or is that realtor that is supposed to basically tunnel all the information to the loan officer?
Yeah, that's a great question. And welcome to real estate. I'm not sure how long you've been in it, but it's an exciting career. I think you'll really enjoy it. So buyer's responsibility, and this is in the TREC contract, buyer's responsible to apply for financing and secure financing. So that means filling out loan application, providing lender with documents. So agent really is not responsible for anything, but the agent should be educating the buyer, right, about how to do it, and what red flags to look out for. Okay. And you'll kind of get a feel for it after you do a couple transactions. You're going to get a home buyer that has a pre-approval letter, and you trust the letter, you go under contract, and there's issues, right?
Right.
I mean, it's bound to happen if you work in real estate long enough. But yeah, it's really the home buyer's responsibility to apply for credit, talk to a loan officer, and hopefully do that earlier in the process, not the Friday before they want to write an offer on Saturday.
Makes sense.
Because there's a lot of things that go into pre-approval, and there's some opportunities to save money if they start 2 months early and get their credit, tweak their credit just a little bit.
Okay, thank you.
Hey, Ben, I think your audio is out.
That we cannot able to hear you, Ben.
Yeah, I think he's on mute.
Oh, is that better now? Maybe my internet went out.
Yes, thank you, Ben.
Okay, great. So for some of our newer agents, the purchase timeline, when after your home buyer gets that pre-approval in place, hopefully a week or two before writing the contract, going under contract. Next step, you're going to make the offer to the sellers, and if it's your first contract, you're going to call the RE Connection broker hotline, make sure they walk you through.
And your audio is out.
No, I can hear you.
We can.
I can hear him.
Hear him, Rachel. No, you are on mute, Ben, now.
Okay.
Can y'all hear me now? It's okay?
Yes, we can.
Okay, now I can hear you. Yeah.
Okay.
I was like, oh.
So when you're writing your offer, if it's your first offer, just making sure you reach out to RE Connection broker hotline, walk you through your first offer. But when you make the offer to the sellers, if they're going to have financing approval, making sure we're picking the appropriate length of finance contingency. A couple years ago, agents were writing like 21 days for financing contingency. I've seen offers that are 5 days. So just making sure that your buyer is comfortable moving that quickly, that the loan officer can move quickly, but also trying to do a shorter period so that your offer is stronger for the sellers. Once you go under contract, and this comes back to the question about what is the agent really responsible for? If you're the buyer's agent and you get an acceptance for your client, just making sure the loan officer knows you went under contract, right? I've had nobody with RE Connection, but a couple years ago, I had an agent that sent me a contract and it had already been 3 days under contract. And I didn't know that the buyer went under contract. And so we're already 3 days late to the game. You know, it's really good if the loan officer knows within a couple hours, right? If it's a Friday and it's 10 a.m. and you went under contract, the loan officer could get the loan estimate ready, could send it to the buyer, call the buyer, and already have the loan submitted to underwriting the same day. So making sure you're communicating with the loan officer, that's really important. The initial lender approval, most lenders are taking 1 or 2 business days to review a new submission. So if it's Friday and you forgot to email a loan officer, the buyer didn't call the lender, right? It's Monday before the lender touches that file. It's going to be Wednesday before you get an initial approval. And so day 0 was Friday, Saturday, Sunday, Monday, Tuesday, Wednesday is day 5 before you're getting even the first bit of feedback from the lender. So, but once you do get initial lender approval, at this point, you're waiting for the appraiser. You've hopefully done the home inspection. You've got a list of repairs to negotiate, or there's no repairs that you need. You might need a new surveyor to go out there. But really, you're kind of waiting on some things to happen, right? Once this bit of paperwork gets done, then we're going to submit back to the lender for that second review, hopefully the final review, and we're going to get final lender approval. That clear to close CTC, sending out the closing disclosure, and then 3 days later, we can schedule the closing date. So that's kind of a rough estimate for the timeline. I might have skipped over a couple things. But yeah, it's important as soon as you go on a contract that the loan officer, lenders are aware so that they can get the ball rolling, especially if you're doing a 5-day finance contingency, because on day 6, your buyer's earnest money is at risk, right? So we really want the initial lender approval to come in before finance contingency expires, because hopefully pre-approval letter was done well and there's no surprises. But if there are any surprises, we want those to come in before that $10,000 earnest money is at risk and non-refundable, right? All right. So during your purchase transaction, we know that working with home buyers can be sometimes frustrating. They tell you they're going to do one thing and then they maybe don't show up for an appointment, or in my experience, working with some buyers, especially younger buyers, and I'm a younger person, so I can say this, but they don't always fill out the loan application thoroughly or accurately, okay? So if you're starting at Friday at 5 p.m., right, they're not going to be ready to make an offer on Saturday. I tell people, apply on Monday or Tuesday, get me some documents Wednesday, Thursday, and let's have a phone call on Friday, right, before the weekend. So always want to get started early. And if you're working with a loan officer that's newer to the industry, you also don't want them to panic and feel rushed. When a loan officer feels rushed, that's when they don't look up their underwriting guidelines. That's when they're not confirming some of these questions. And a loan officer that's new to the industry is not wanting to tell a home buyer no, right? That's a potential commission check, right? Even though they should say no, they might not, right? So you want to give the loan officer, especially if they're newer, give them plenty of time. Don't rush them. Let them do their work and then come back to you, right? when you get that pre-approval letter, make sure you're writing the offer with that appropriate length of finance contingency. If you can do 5 days, if your buyer is super fast, organized, you know the loan officer, you can do 5 days, 5 or 7 days. In other cases, you may need 10 days, 15 days. It really just depends. Remember the date that the seller signed, that's day 0. So if day 0 is a Friday, you're going to lose Saturday, Sunday because lenders are closed. So Fridays are never good to go under contract. If other buyers have 15 days on financing and your buyer has 7, the sellers like your offer better, right? Because they only put 7 days at risk of only getting to keep the option fee and nothing else. The other buyer, they had to wait 2 weeks and they might cancel on day 14. Sellers only got to keep option fee, right? So your buyer is a stronger offer. There are 8 fewer days of risk for the seller, okay? Let the loan officer know as soon as the offer has been made to the seller, even before it's been accepted. I've had buyer's agents ask me to call the listing agent, email the listing agent. I'm very limited. I cannot go into detail about the buyer's employment, finances. So I really can't get into detail about anything. But what I can do is I can just reassure the listing agent that this is a good buyer, right? We've done the work we needed to do to get them done. So,
Hey, Ben, question.
yeah, go for it.
Hey, so you said that if the lender or the loan officer knows the buyer, what do you mean knows the buyer? Typically, wouldn't you have new customers coming in all the time? Because this typically wouldn't happen till an offer is accepted.
I'm not sure what you mean. So if the loan officer knows the buyer, like is super organized, or
No. You said right
it is
that
true. Most of the
you
clients,
actually are familiar.
yeah, I don't know. Yeah, most of the buyers that a loan officer is going to work with, they don't know them, yeah, until they've been referred over. But
Right.
yeah, but you do get a feel for a buyer, right? If they respond quickly to emails, requests for documents, or if they don't, right? So you kind of get that feel for a client whether or not a short finance contingency would be good for them or not.
But that's my point. So as a loan officer, maybe you can make that call as a judgment call based on the numerical statistics that you have. But as a real estate agent, how do we predict that before you even get the application? So for us to even put 5 days or 7 days on an offer is virtually not possible until the lender or the loan originator would actually provide us that kind of assurance. You know what I mean?
Yes. Yeah, I know. And that goes back to Hema's question, just needing that realtor loan officer, very close communication. Because yeah, as a realtor, you don't know if you're dealing with a self-employed borrower with very complicated financing, or if this is a W-2, 800 FICO, 20% down, really easy file. So if you have questions about finance contingency, call the loan officer. Say, hey, what do you recommend? Can we do a shorter period or do we need to do longer? A good loan officer should be able to give you that feedback and let you know how quickly they can move, how quickly their underwriter can move too.
Okay.
That's a really good question. Yeah. Yeah, because a lot of times agents are in the dark and I hate that, but loan officer may have some more insight that you as the agent, you're not aware of, right? How the communication has gone on behind the scenes, getting that pre-approval finished. Because some clients are great to work with, they're on top of things. Other clients, it's so hard to get documents, and you just know once they go under contract, things are not going to get faster. They're probably going to go slower, right?
Ben, I have one question. This is Jagdish.
Yeah, go for it.
Yeah, if buyer wants to shop around for a mortgage, right? Like when is the best time to start that process? Like if they ask us, buyer ask like when to start that process. Like
yes,
closing is nearing around 2 months. Like what is the best time?
Thank you for asking that. That's such a good question. So first of all, a lot of home buyers don't know that they should comparison shop. I wish that all home buyers comparison shop the way that I've seen a lot of buyers recently shopping, right? My recommendation, if I were to be a home buyer, borrowing a mortgage, knowing what I know in the industry, before I go under contract, I would have 3, 4, 5 lenders that I have their email address. I have maybe talked to them on the phone. As soon as you go under contract, right? The day you go under contract, you need to fill out the loan application, authorize a credit pool, and within 3 business days, the lender's going to send you the loan estimate, right? So worst case scenario, if you go under contract on Friday and you send your 3 lenders your contract, you fill out the application, pull credit. Business day number 1 is Monday, Tuesday, Wednesday, 5 p.m. You're probably going to have 3 lender offers. And Thursday morning, you look at all the offers and you pick the best one, right? So now you're only day 6 under contract and you decided who you're working with. But yeah, a lot of buyers are waiting till day 10, day 15, and that's really kind of too late, especially if you've got complicated financing and you've got a large earnest money that's at risk, right? I would try to comparison shop as soon as possible. And you can do some things before contract, like filling out the loan application, authorizing the credit pool. That way, all the lender needs to do is when you email them that sales contract, they've got the property address. Under federal law, 3 business days, they're going to send a loan estimate. So your client can see who's got the best offer. Yeah. Kala, let me get your question.
Hey, Ben, thanks again. I do have one question that oftentimes the buyers are asking me. If they start shopping for different loan officers or loan mortgages, how are their credit score affected? It's going to be a hard pull or a soft pull? All the time they're scared of this.
I know. That's why I tell folks that they can apply with me with the soft pull, even though I know that a hard pull doesn't actually hurt them. So if you go to FICO.com, FICO.com's got a lot of resources about credit scores. The FICO score is the Fair Isaac Corporation. They own the algorithm. And a hard credit inquiry, if you have multiple inquiries with lenders within 45 days, it's not going to be multiple hits, right? Because the algorithm knows that this person is they're not looking to take out 10 loans. They're looking to take out 1 loan, but they're comparison shopping. So I tell folks, if you want a comparison shop, try to do all your hard pulls within 14 days. But I mean, you can even go 30 days, 45 days, and it's not going to hurt you. And if your credit score is at 800, you're going to get the same price if your score was at 760. And a hard pull might move your score 5 points, right? So most people that are nervous about hurting their credit have excellent credit, and it's not going to hurt them. Most people with lower scores aren't asking that question, and they should be.
Well, thank you so much, Ben. This was so much of clarity. You explained.
Ben, is it each hard pull is take 5 points every time?
Yeah, worst case might be 5-10 point decrease. And like I said, if you're applying with a lender on June 1st and you apply with another lender July 1st, those 2 inquiries count as 1. And they're not even built into the algorithm for your pricing until you pulled it beyond July 1st, right? So, because it's always a look back. So they're looking back beyond, the date of inquiry. So it's not that you apply with a lender and your score fell that day when you pulled it. It's in 6 months when you pull your credit again and they look back and they see that inquiry. And it's a very small hit, and the impact goes down over time, right? So, and the biggest hit is somebody who's in financial distress applying for credit cards, right? So, because a lender sees, you're applying for credit cards, what's going on? Did you lose your job? What happened? You're perceived to be higher risk. Multiple inquiries for mortgage, not as big of a deal.
Okay.
Yeah. What else?
And this is Yogesh. I had a question.
Yeah, go for it.
So once you get the loan estimate, how much time has the buyer to accept that or decide? Is it like 3 days, 4 days, or there's no time?
No, that's a great question. Yeah. So So the lender's underwriter is kind of in a holding pattern until the borrower signs. So signing the loan estimate is not as big of a deal as a lot of home buyers think it is. The buyer's not committing themselves to the loan. The buyer's not paying for an appraisal. They're just signing it so that the underwriter can look at the file. Most lenders, underwriter won't even look at the file until loan estimate has been signed.
Okay.
But your question, if they don't sign it for like a week or 2 weeks, the lender is still able to move forward with them, but obviously the rate will have shifted, right? Because
Yeah.
rates are so volatile. So if the loan estimate shows a rate and it's not locked in, even if they sign it, a week later when they do lock, it's going to be a slightly different price, right?
Okay.
Yeah. So I tell people, go ahead and sign the loan estimate, even if you don't know if you're going to work with me, right? Because I do want to get you that underwriting approval before your earnest money's at risk, right?
Yeah.
You can still look at other offers, but let's go ahead and get that underwriter to look at your file. And it's not binding. You're not committing to anything. The only thing a lender can do once the borrower has signed, they can send the invoice for the appraisal. And you really need to know at that point who you're working with.
Okay.
You know, once you pay for the appraisal, you can transfer an appraisal to another lender, but can you imagine how awkward that is, right?
Yeah.
The borrower is saying, hey, I want you to transfer my appraisal. Legally, they are going to transfer it, but it's tricky, right?
Okay.
Yeah.
So the best way is if you get 3 different offers, just sign it, and then you still have time to back out and decide on one vendor, right?
Right. The time that you're really kind of committed is you pay for the appraisal, although you're really not committed yet, right? Because you could transfer the appraisal, and the buyer's never committed until they go to closing and they sign the note, promissory note. Right?
Okay.
Yeah.
Cool.
And on a refinance, they could even cancel it 3 days later. But
Yeah.
So yeah, a lot of people are nervous about signing anything, but I tell them I need you to sign so I can get you underwriting approval, because we need that approval to protect your earnest money. So most underwriters, they're going to take 24, 48 business hours. So if we send it to underwriting on Friday at 5 p.m., probably going to hear Wednesday morning, 8 o'clock, right? So
Gotcha.
really great questions. When you get an email from loan officer saying, congratulations, initial underwriter approval, what does that mean? That means that hopefully we've cleared all the high risk lender conditions: employment, income, asset, debt, housing payment, including the tax certificate, home insurance quote, right? Because sometimes those 2 numbers, we don't have those numbers verified. Though there are some other things that underwriting needs to clear, like, unexpired photo ID, right? Maybe the buyer gave me a ID 3 months ago and it's expired. Now we need a new one. That's not a condition that's going to make or break the mortgage, but it's something that's waiting for final approval. But we want those high risk things, like if there was a 90-day employment gap between jobs, if we're using overtime, commission income, we want to know that the lender is going to let us do those things. We think they will, but we need to know that on the initial underwrite before finance contingency expires. So, and that's it. That's really kind of my
Hey, Ben.
tips on that.
Yep.
Yeah, go
I
for
know
it.
we are running out of time. If you don't have time, I can ping you later.
No, that's okay.
Okay, thank you. As you mentioned earlier, that mortgage rate has gone up 3% since last year around this time. So adjustable rate is coming back. What are your views on when it's a good idea to have adjustable rate versus conventional loan?
Oh my gosh, I think that you hacked my email and you already knew what this slide was going to be about. No, I'm literally going to talk on adjustable rates. Yeah, right now. So rates are high. Like Darshana said, 3% higher than they were a year ago. So we've got to ask ourselves, there's a lot of home buyers that are not qualified for a mortgage anymore. So $400,000 mortgage, the payment is over $600 higher every single month. So Maybe you had a friend of yours say, I'm going to wait a year and buy a house later. They can't get lender approval now. Let's say they had $10,000 monthly income and the housing payment a year ago was going to be 40%. We don't want it to be higher. With that extra $642 monthly payment, now their debt to income is 46. They cannot buy the house unless they want to bring a very big down payment, or they're going to have to buy a smaller house, right? So your buyer's not going to be buying this year. There's a lot of buyers not buying. And with fewer buyers in the market, right, home prices are going to slow down. Sellers are now competing for buyers. They're going to have to cut prices to sell their house. It's good for the buyers that survive. It's good for the buyers that can still buy, but it means that homes are going to sit on the market, more days on market, sales price coming in closer to list price, more room for buyer negotiation, less of a seller's market, still a seller's market, but not as hot. And our appraisals are going to start coming in where we need them to now. So what can we do if rates are close to 6%? What can we do to help our buyers? And is an adjustable rate right for some of our clients? As you can see, we got some rate improvement today and yesterday. Rates were 6.3 last week. They came down to about 5.88. This is the 30-year fixed rate conventional. And guys, if you ever want to check out what's going on with mortgage rates, you can check out this website. This is one of my websites, and see what's going on with rates on a daily basis. So let's talk about the adjustable rate mortgage and see if this might be right for some of our buyers. We want to think strategically. A lot of clients are asking, I want to get the lowest interest rate possible. And that's not a weird thing to ask. We all want to get the best price if we're buying a car or we're buying a pair of shoes, anything, right? We don't want to overpay for a product, especially like a mortgage, right? But if we're planning on the bigger economy going through a hard time next couple of years, I think Fannie Mae, Freddie Mac are expecting there to be a recession. It could be a mild recession, could be more than a mild recession next year. But if we have a recession, mortgage rates are going to come down. A lot of our buyers are probably going to refinance. So if we're going to be refinancing in 1 or 2 years, we want to make sure we're not buying down the interest rate. Because remember, I mentioned home buyers can choose 10 or more interest rates. They could choose a high rate with no lender fee, or they could get a rate 0.5% lower, but it costs them $5,000 or more just to drop the rate, drop that monthly payment, maybe $50. But if you're going to refi it in 1 or 2 years, does it make sense to pay that high upfront fee? And then you only enjoy that monthly savings a very short amount of time. It just doesn't make sense. So I'm encouraging home buyers to actually get a higher rate with no lender fees, because we are going to probably see lower rates next couple of years, right? If the buyer refinances very soon, within 5 years, there's another product. A 5/6 ARM might be more appropriate. The 5/6 ARM, it's still a 30-year mortgage, but the rate is only locked in the first 5 years, okay? Starting in year 6, the rate could adjust every 6 months. You might have heard of adjustable rate loans before 2008 and how horrible they were, and they were. Adjustable rates in 2005 and 6 were horrible products. A lot of people didn't know what they were doing. They were pushed to people inappropriately. Today's ARM is different in a lot of ways. I encourage you to do some research on today's adjustable rates. It's tied to a different index than it used to be. And there's some consumer protections that were not in place 10, 20 years ago. If we think about it, if our inflation in the economy is at 8%, above 8%, the companies buying mortgage bonds, if mortgage rates are below 8%, investors are actually losing money. But with a adjustable rate mortgage, investors are protected because the rate is only locked in for 5 years. And after that, rates can float up or down. So because of this protection for the investor is willing to give the borrower a better deal. So today, a 5/6 ARM has a rate closer to 5.25 versus 5.88. That's about $200 a month saved for a $400,000 loan. So when would an adjustable rate not be appropriate for somebody? What if your client cannot refinance in 2 years, right? If they lose a job, or if some other major life event happens where interest rates are lower, but they are not able to refi, and it's coming up on the end of that 5th year, and they're getting into year 6, and they're not sure what their new interest rate is going to be, right? That's somebody who needs to be more cautious and more hesitant before they agree to take out a loan that is a adjustable rate. But I did want to show you side by side the pricing difference. So guys, remember how I said every buyer can choose a couple different interest rates? Well, on the left-hand side, on the ARM choices, look at the very first option. The rate is 4.75, and it's costing the borrower over $8,000 to buy down the interest rate. Now go all the way down to the bottom. The rate is 6%, much higher interest rate. But you see that negative sign? That's a lender credit. The lender is giving them almost $6,000. So the difference in pricing is about $4,000 difference. So instead of the buyer using the 30-year fixed loan, they're going to a 5/6 ARM, saving about $4,000. And they can use the savings to buy a lower interest rate. Or what I would do is keep the rate higher and avoid paying lender fees, right? Because in a year or two, a lot of people, if they're able to, might look at a refi. So any questions about these lender pricing? I know these are kind of sometimes complicated to look at if this is your first time looking at that. So I don't want to go too quickly over this.
Hey, Ben.
Yeah, Carla, go ahead.
May I ask you something related to new construction? Let's say I have a buyer who has contracted for new construction, and it's going to probably close in 6 to 8 months, hopefully.
Mm-hmm.
So how would you suggest some of the builders, somebody can, kind of help me. Some builders are right now giving 120 rate lock, 120 days rate lock and stuff like that. If the buyer comes to you asking what's the best thing to do, of course, I'm going to kind of guide them to meet their lender and talk to the lender. But overall, based on what you said right now, I'm thinking probably they should wait, saying that it might come down over a year or so. But what's your thought on this? If it's a new construction, they are going to wait another 8 months. What would you suggest? From your thoughts would be really, really appreciated.
Yeah. So Carla's question is a good question. A couple parts to that question. We've got the builder's preferred lender and the incentives that the builders are giving, which are massive incentives a lot of times. My go-to response is work with the builder's lender, right? Because you're going to get $10,000, $15,000, $20,000 builder credit for kitchen upgrades, finishes, right? The second part to the question though is, the buyer is not ready to close yet. It's going to be 6 or 8 more months. What might happen to interest rates in those 6 to 8 months? So Carla's got a great question is, what should the home buyer do in this scenario? What the home buyer could do is choose to go ahead and lock in with the builder's lender. So long as the client knows that they are going to buy the home with this builder, because a lot of builders lenders are requiring the buyer to go ahead and put down the deposit for the house before they will lock it in. So if there's any doubt, any questions about whether or not your client is going to get the new construction, maybe hold off on locking with the builder's lender. If your client was looking to buy a resale house, not a new construction, they could reach out to any lender. And there's a lot of lenders out there that are offering a 180-day lock for the interest rate. But what the lender is doing is taking today's interest rate and then tacking on a fee. It's not an upfront fee, but it's added to the borrower's rate or lender fee at closing to offer them that that advantage of locking in today. I have a couple that locked in with me in March, and they're going to buy a new construction later this year. I think I might actually have a better offer than the builder's lender because the rates have gone up by 1.5% since we locked in. So it doesn't cost anything to lock your buyer in for 180 days. What it is going to cost them is a pricing adjustment at closing. So the gamble that you're making is still worth it to lock in today, because if rates go up higher, you're guaranteed. But if rates fall, you can always work with a different lender because you're not promising the lender you're going to work with them. So as a mortgage broker, I've got a couple different lenders. You know, I might lock in pricing for one of my buyers, but I'll tell them if rates go down, we'll go work with a different lender because you're not committed to that one lender. So hopefully.
Ben, I have a question. They're asking for a price to lock in. They usually ask the client to pay like $2,000, $3,000 to lock the rate in. And now you're saying it's free, you know, it doesn't cost the buyer.
Yeah, so I don't know exactly what builders lenders are offering these days. I only know that with the lenders that I work with, we are not allowed to charge any upfront fees until we've given the client the loan estimate. At that point, some lenders may ask for a lock fee. Would I pay it? I'm not sure that I would, because there are lenders out there that will lock without asking for any fees up front. So other lenders may be asking for that. But I don't know if I would pay it. Yeah.
Okay.
Yeah. Once you're,
If you're locking for 90 plus days, is it advisable to lock for $500 or $700, like, you know, pay that fees and lock it down?
I couldn't hear you very well. I think your question is about locking beyond 90 days. Is that right?
Yes.
Okay. Yeah, so traditionally lenders offered a 15-day lock, 30-day lock, 45 days, 60 days. But with a rising rate environment we're in, lenders started offering much longer, 90 days, 180 days. And some lenders are charging a fee for that. Other lenders are not charging an upfront fee. I would try to find a lender that's not charging upfront fee for that service. And then you've got that as a kind of insurance. And if you don't need it, you're not tied to that lender.
Got it.
Yeah.
Thank you.
All right. And I know, guys, we are over. Let me really quickly blow through. I think I've got two more of these slides. I know earlier I had talked about credit scores, how we can save our clients money just by a slight increase to credit scores. So every buyer's got 3 scores because there's 3 credit bureaus: Equifax, TransUnion, Experian. They're all looking at the same data, or almost the same data, to give us the 3 FICO scores. Lenders are always looking at the middle of those 3 scores. If you got a husband and wife, they're looking at the middle score and they're pricing the loan based on the lower of the 2 middle scores. So let's say that our couple is buying a house and the score we are using to price the loan is a 719, okay? And the buyer's comparing lots of lender offers. They want to get the best pricing. What's the problem? Nobody told your buyer all they need to do is boost their score to a 720 and they're going to get better pricing, okay? Lenders charge the lowest rates, lowest fees if the credit score is over 760. 760 or 800, same pricing. So people tell me, oh, I've got an amazing credit, it's like 800. I'm like, yeah, I don't care. Not to be rude, you know, but a 760, 780, 800, it's all going to be the same pricing. So I wish that weren't the case. I wish people with 800 got lower rates, but that is the way it is. And a score between 740, 759 is actually the same lender pricing, because lender pricing moves in a 20-point increment. If you're under 740 though, 739, instantly you're now in a different pricing tier and you're going to pay a higher price. So we really got to keep an eye on our buyers. If they've got a credit score that's right on the edge, there are some things we can do rather quickly in some cases to bump it just a little bit. We don't need a huge improvement. We just need a small improvement, and it could potentially save them a couple $1,000s. Last slide, guys. 20% down payment. I know that a lot of our clients come to us saying, I want to do a 20% down payment, but let's talk about mortgage insurance. Mortgage insurance kicks in for a conventional loan anytime down payment is less than 20% based on the appraised value. So sales price is 600,000, but it appraises at 550. The loan amount is based off of the 550, not the sales price of 600, right? So if appraisal is 550, then the borrower needs 20% down, which is 110,000, plus they need cash for the difference. Okay, hope that makes sense. But they can also do 10% down payments, and they're going to pay a little bit of mortgage insurance, or they could do 5%. The fact is, guys, people with a high credit score are more likely to repay their debts than people with lower credit score. And the companies that offer mortgage insurance, they know this, right? They're not going to charge people the same price for mortgage insurance if they have a really great credit history. So your buyer may have some other investment goals. And even if they're able to bring 20% down payment, if they're a first-time buyer, they can do 3% for conventional. Everybody can always bring 5% down for conventional. If your client is looking to buy a house for 600,000, a difference of 5% instead of 20% down is 90,000, right? There's a lot of things you could do with 90,000. The cost of private mortgage insurance with even a decent credit score, this isn't like a great credit score, 720, it's about $2,400 a year. That's 2.7% on the 90,000, right? It's very low cost. For a higher credit score, it costs even less. All right, guys, so that's really just to wrap up. That's the presentation for tonight, helping your buyers, making sure they get pre-approved early in the process so we can find those little credit blemishes, help them finish, fix those. Make sure you get a high quality pre-approval. Make sure you're not rushing the loan officer. Give us plenty of time, because you don't want loan officer to make mistakes that are gonna haunt you later on once you're under contract. And know what happens once the sellers say yes. Once you're under contract, make sure your loan officer is getting the contract. Make sure your buyer gets the loan estimate very quickly. Make sure your home buyer knows it's okay to sign the loan estimate, even if they're not sure who they're going to move forward with, right? Because we need that loan estimate signed so that the underwriter can give us initial approval. And we need initial approval before finance contingency expires. We want to make sure our home buyers are picking the right mortgage, not the lowest interest rate, but the lowest lifetime cost. If we're going to hit a recession next year and rates are going to fall, let's go ahead and get a higher interest rate now and avoid the lender fees, because that's an option. We don't have to pay large lender fee, get a lower interest rate. If rates are going to drop 1%, it'd be better to have a high rate now and enjoy a bigger drop when that does happen, if that happens. Very small improvements we can make to credit can make a huge difference to the price we pay for credit. Private mortgage insurance is not scary. So, guys, I do have a WhatsApp group just to share mortgage news, tips, some marketing tools for you guys. Feel free to check that out, blue.realty.org/WhatsApp. And if you ever want to check out mortgage rates, check out my website, and you can see all of the mortgage rates: 30-year fixed, 15-year fixed conventional, 30-year FHA. Jumbo pricing is really good right now. almost 1% better than the 30-year conventional. And remember, guys, jumbo is that really big mortgage. It's over, I think it's like 625,000. I always forget the number. And notice that 5-1 arm. Notice how big of a difference pricing is. So the adjustable rate, it might be the right thing for some of our clients. Just make sure we're having the conversation with them and that they know what they're signing up for. Because we want to make sure a client is not surprised later on, and make sure that they know the difference between the rate locked in for 30 years versus only locked in the first 5 years. So that's it, guys. If you ever need to reach me, you've got questions, feel free to text me. I am normally by my phone getting calls and texts from homebuyers agents. So I will get your text. I will text you back. If you have a longer question, feel free to email me. If you need me to research something for you, you got a weird situation with the home buyer, I'm happy to look up underwriting guidelines. If you like this class and you want to nerd out even more, I have a longer mortgage class. You can get some CE credit for the class. I think I also have a free version. You can take the class for free without the CE credit. So check that out. And thank all of y'all for being a great, great class. Thank y'all for letting me come in on your Wednesday training. I know you'll have a lot of other things you could do on Wednesday night. So it's been great. Great doing the class with y'all. And any last questions before we wrap up? I know we are over time.
Hey, Ben, a couple of things. One, I really enjoy your newsletter every Friday. That's really cool.
Nice.
And so you mentioned about your extended class, free or the CE one. Where could we get links towards that?
Yeah, so the before I became a realtor last year, I contacted Trek to get approval to teach a 7-hour CE class. So if you check out mortgagemission.org/CE,
Okay.
that's the link here. Here on the slide.
I see it. I see it. Yeah.
Okay. Yeah. Click on that. And if you want to take the class, but you don't need the CE credit, I think about the class at $40. If you don't need CE, send me an email and I will get you a free access to the class.
Okay.
That way you can just get the knowledge and the information, but we don't have to we don't have to worry about posting CE credits.
Got it. And lastly, this has been a great presentation, right? So I was just wondering, is it possible to maybe this question to Rachel, where would the recording for this particular class would be?
Yeah, I will definitely follow up with Rachel and Ketan, and we'll get a copy of this. If y'all want me to send it out to you, shoot me an email, and I'll also send you the copy of the slides, the PowerPoint slides, if y'all want a copy of that as well.
Yep, doing it right now. Thanks, Ben.
Okay, awesome. Yeah.
Thank you, Ben.
Yeah, and if y'all like this class, let me know. If y'all have questions next couple of weeks, I can get all your questions. We'll do another little, not as long as this one, but this is just the 101. It's starting from basic questions to getting more comfortable with some of these concepts. But like Kala's question was a great question about using tenant income to buy her new house, right? That's a really good question on some of those more complicated scenarios. So.
Thank you so much.
Guys.
It was very informative.
Yeah. Any other last questions, or y'all ready to call it a night?
One foolish question.
Yeah.
Thank you, Ben.
Go for it, Geeta.
Yeah, buyer got the appraisal, and the listing agent is asking for the appraisal.
Yeah, so that's a great question. If you're going to terminate your contract based on a low appraised value, and that's a real estate question, and I am new to real estate, so I'm not the best person to ask.
Okay.
But the buyer has paid for that appraisal report. The report belongs to the buyer, and the client for that report is the lender. So the seller is not involved in any way. But if the seller asks for that report, contact, RE Connection, have them look at it with you and to see what you need to do. I think there are some scenarios where you might need to provide that, right? Especially I think if you're going to cancel contract based on low appraisal.
Or I can just tell them the number.
Yeah, you could tell them, oh, it came in low. They might ask you for evidence of that. Yeah.
Right?
Um,
I didn't answer yet. Because
If on the termination agreement,
Yeah.
there's
No.
usually, there should be one of the things like buyers terminating due to lender.
no,
Or
buyer
not.
needed to pay for the difference. He knew already that the appraisal will come low.
Okay. So what you're saying, Geeta, is you're not terminating contracts. The seller was just kind of curious what the number came in at.
Right.
Yeah,
Because
I would
I would
not
like
share the report
Yeah.
unless buyer wants you to, because
Yeah.
that's tricky. Yeah.
And then only after closing,
Yes.
once you
Yeah.
have the house.
Yeah.
But
Yeah.
you're-
I don't feel good to share the inspection report
Oh,
with the
yeah.
seller because of that I am terminating and they will get benefited with this,
Yeah.
So I don't know, but we share inspection report. We share.
Yeah,
Yeah.
I don't normally send inspection reports in full to a seller. I'll just break it down into what bits and pieces we're asking repairs for. That's usually a best practice.
Yeah, you do that only if you want to screw up with the seller. Don't do
Yes.
that.
Yeah.
Yeah. And that brings up another question, repair amendments. Sellers, the lender does require any amendment to the contract to be submitted. But don't be afraid of a seller repair amendment. It's not going to hurt your financing. An FHA mortgage is slightly different. Like FHA appraisal is slightly different than conventional. But if you got an amendment to your contracts, let the loan officer know, because we do want to make sure that we're aware of all that stuff. Yeah.
And then going back to the original question, Geeta, if your buyer did plan to terminate because of the appraisal, on the notice of the buyer's termination contract, where they would check, they're terminating because of the appraisal, it does say the buyer has delivered a copy of their appraisal to seller. So it is part of the notice that you're required to do, that you should do that.
Thank you.
And that's track number 38-7. That's the form. All right.
All right, guys.
Thank you so much, Ben. This was really informative.
Yeah, I enjoyed doing it. I had to go through some of my old notes and like kind of pull it together, but it's good practice for me, like to actually, just because I know it, I have to find a way to like walk people through it in a way that makes sense to other people. So, but we'll definitely get a recording, guys, and I'll keep these slides. We may do some other training in the future. Like I've got a title company. We might do a training class with title company where I'll come in and talk a little bit about mortgage too. So, if I've got your email, I'll put you on that list of any events that might come up. And I think we might have some things with RE Connection in the future, some cool things coming up, but a little too early to talk about that. So hope you guys have a good evening, and I will see you all at the next mixer.
Thank you, guys.
Thank you.
Thank you.
Good night.
Okay.